Welcome everyone to today's webinar. Our topic is using your IRA and 401k to invest in real estate and other alternative assets. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Quickly want to introduce Brett here. As I said before, he's the one presenting. Brett is our solo 401k and self-directed IRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Welcome, Brett. Thank you for taking the time to present today. I will let you take it away from here.
All right. Yes. Thank you very much, Natalie. Really appreciate it. And thank you everybody else for jumping on and taking time out of your busy day to be with us for a little bit here. Hopefully provide some value to you. I can almost guarantee you'll learn something new, and definitely type in your questions as we go because I don't want you to forget them and wait till the end. And just type them in and we'll collect them at the end and go through them one at a time. And we generally have time to get to all the questions. First off, our mission here at Sense Financial is helping clients obtain control and protect their retirement accounts. Good planning and hard work lead to prosperity. Proverbs 21:5. And you work hard for your money. We want to come alongside you and work hard for you as well in the capacity that we provide here with self-directed retirement accounts. First off, why should you listen to us? Well, most of our business comes from existing clients, from referrals. We have referrals from outside sources, of course, but most of the referrals come from existing clients, which tells us they're happy with us. Now, the other thing that tells us they're happy with us is the 5-star reviews we have on Google, Yelp, even some Facebook reviews. Trustpilot is another one. And so if you're thinking about doing business with a company that provides the service we do, I highly recommend you check out the reviews first before jumping in. That should tell you a little bit more about them and what their clients think primarily. We've been in business since 2010, and we only specialize in 2 products. We have the Dmitry Fomachenko, the founder of Sense Financial, has very consciously said no to many, many ancillary product add-ons that he could have added along the years for a couple of reasons. One, he really believes in keeping it simple. And 2, he really believes that we can provide a much better service to our clients if we are focused. And if we spread ourselves too thin, we will not be focused. So we only do 2 products, the Self-Directed IRA and the Solo 401k, which we will be covering today in some detail. Now, before we do that, I want to talk about the power of the self-directed versus the conventional investing. So to do that, we're going to use a little diagram here. We have the bus on the side, and it's actually kind of like a train because it's on tracks, but you have to go to the stop at a certain time. You have to get on it at a certain time. It stays on the track, takes you to some destinations along the way. As far as pre-scheduled stops, you have to get a ride to or walk to the pickup spot, and then you have to do the same at the drop-off location. And so you're relegated to the confines of where this train/bus has to actually can actually drive or move along on. On the other side of it, so that's the conventional side, right? Think about your stocks, bonds, your mutual funds, ETFs, as far as investments goes. Nothing wrong with those. They've made a lot of money for a lot of people over the years. However, we're here to talk about the self-directed side of things. Now, that's your off-road vehicle, right? It can go where the bus or train can go, but it can also go off-road through some water, over some rocks, has a higher profile, 4-wheel drive. And this represents what I'll call the Wild West of self-directed retirement account into alternative assets, of which there are nearly unlimited options. As creative as you can get, just about. We'll talk about a couple of exceptions towards the end here, but just about as creative as you can get, you can actually invest. Most of the clients that we take on fit in a few categories as far as what they desire to invest in. Most of them are real estate in one way, shape, or form, but we have a lot of people doing precious metals, Bitcoin, and other types of cryptocurrency. A lot of people doing private lending, commercial real estate, residential real estate, tax deeds. Some people like the passivity of investing in a debt fund that's in existence, that's already there. Throw your money in, you can take it out anytime you want, get maybe 8 to 10% ish on your interest rate, but it's secured by real estate. So it's much more secure and reliable than the stock market, really, because you don't have any control over that, which I'll touch on here in a little bit some more. But yeah, many of our clients invest in real estate for that reason. Not just the debt fund, not just holding properties, but a lot of them you can actually originate the trust deeds, the mortgages as well. You're going to get a better return if you do that, but it's not as passive as just throwing your money into an existing fund that somebody else is managing. So first off, next rather, I want to get into a demonstration here of a story about Brad and Jennifer. Yes, their names were changed, out of Phoenix, Arizona. Now, Brad is a real estate agent. His wife joined him in the real estate business, and they were primarily, still are actually, primarily helping people buy and sell the place they call home as real estate agents. Okay. Now, Brad had some money in mutual funds and 401ks and the stock market. And when he got his real estate license, he, along the way, discovered the solo 401k, which is one of the products we offer here at Sense Financial. And Brad and Jennifer, his wife, both have been a client of ours for many years. But when he discovered this, he realized, hey, I don't have to just invest in the stock market. Yeah, the mutual funds are good. They're spread over 500 different companies or whatever. There's some diversification, but at the end of the day, you're in the stock market. It's the same sort of vehicle. Now, he discovered that he could open up those funds, unlock them, jailbreak them, is what we like to say, in the form of a solo 401k, and another step further, in a solo 401k that actually allows for alternative asset investing. And so he said, okay, I can invest now in rentals, multifamily, and he did that. He started buying rental properties and investing in commercial real estate as well. And his result, by the way, he was doing most of this in his Roth solo 401k, and he now has millions of dollars in real estate in his Roth. And you know what that means? That means that he and his wife, they paid taxes in their Roth accounts on the seed, but they're not going to pay it on the harvest. Right now, they're already over 59 and a half, so they can take distributions without any penalties. In the Roth, there's no taxes either. So it's the best of both worlds in that situation. So what are the options? Okay, I already alluded to this at the beginning. Well, we do the two products of the Self-Directed IRA and the Solo 401k. And we're going to talk through each one of these, but suffice it to say, the Self-Directed IRA is actually for really anybody can do it. There's not a lot of qualifications. Now, I will say, because the annual contribution limits are limited in the IRA, 7,000 or 8,000 if you're over 50, generally speaking, if you're going to self-direct into alternative assets, it makes sense to have some existing retirement funds, either in a 401k, 403b, IRA, whatever it is, to roll into or convert into a self-directed IRA. Because if you start out from scratch and you just fund it from contributions, 7,000, 2 years later, 14,000, obviously you're going to invest, it's going to grow a little bit, but it's harder to do that with less than 20 or 30. Although there are some crowdfunding options that you can get into real estate without becoming a landlord, that I've discovered along the way, that will allow for investments as low as $100. So quite amazing that that's allowed now, and technology allows people to do that, and you don't have to be accredited to get into some of those either, which is also very cool. So even if you don't have a lot, it still can make sense. But generally speaking, I'd say 98% of our clients roll some funds into the IRA, a fair amount to self-direct. Now, on the other side, which is the solo 401k, the reason there's only a couple sitting there is because it's primarily for the business owner and their spouse. Hence the word solo, right? Bible says you have become one when you get married, so you and your spouse are considered one in the eyes of the IRS as well in terms of the solo 401k. Once you start adding W-2 employees that are full-time, you actually cannot do a solo 401k anymore. It's not solo, your business isn't solo. So now you're more into the group 401k categories, which we don't do here at Sense Financial. So solo 401k actually is powerful enough from an annual contribution perspective to start out from scratch, to start out from zero and just fund from contributions from your business, because unlike the IRA, the contribution limits are 10 times the amount. 69,000 if you're under 50, 76,500 if you're over 50. So in a year, if your business is doing well enough, you can have a fair amount of money in there, not even a full year. Right after you establish it, actually, you can start funding through contributions. So that's the major difference between the two and what it takes to qualify. Let me go back a little bit. The solo 401k does have the self-employment requirement attached to it. Unlike the IRA, you don't have to be self-employed at all, or you can be self-employed and have employees and still do the self-directed IRA. On the solo 401k side, you have to have what the IRS says is legitimate business activity. Okay, this is not passive income. A lot of people come to us and they say, hey, I've got 10 rental properties. I'm living off the rent. By the way, I high five them every time I hear that, because that's an awesome accomplishment. They don't have to go punch a clock anymore or work for somebody else, and they're just living off mailbox money. It's fantastic. The problem with that, with the solo 401k, is that Schedule E passive income does not qualify you for legitimate business activity per the IRS guidelines. You actually have to actively work for the income. Now, a workaround in that situation, which a lot of our clients have done, is you can form a property management company very easily, and that is now active income. You can pay yourself 8 to 10% of the gross monthly rent, and then you can qualify for a solo 401k. Now, in that scenario, you may not be able to take advantage of the high contribution limits because, I guess it depends on what your gross monthly rent is, because if you pay yourself 8 to 10% of $1,000, you're not going to get to the $69,000 or $76,000 maximum contribution. But what it will allow you to do is, yes, make some contributions, but also roll over any existing retirement accounts, with one exception that we'll talk about, into that solo 401k to self-direct. And I'll talk about the differences of why the solo versus the IRA, why the 401k versus the IRA as well, if you could do either one. First off, let's talk about the IRA, aka the checkbook IRA. Essentially, we call it checkbook IRA because it has what's called checkbook control. Here's how it works. I will talk more about checkbook control. When you say, I'm ready to become a client, first thing we will do is open an IRS, a new account with an IRS approved custodian. Now, this a custodian, by the way, examples of, I'm sure many of you on the call know this already, but examples of a custodian are Fidelity, Schwab, T. Rowe Price, Vanguard. Those are custodians. Now, those are not the custodians we're talking about, because when you have your money there, you are locked into what they offer. They might call it a self-directed account, by the way, but their definition of self-directed is, do you want this stock, this bond, this mutual fund, or this ETF? Because that's all they offer. What we do is we open this account with an IRS approved custodian that also offers alternative assets to be held. Now, again, with the well, I'll come back to the checkbook control in a little bit. So the next thing that we do during this setup process, which, by the way, is about 3 to 4 weeks, depending on how quickly you respond to what we need. But during this time period, the custodian account is opened up. The transfer from any existing retirement accounts is also initiated, which we assist with. Could be a current IRA, Roth, or traditional 401k, 403b. Any qualified retirement account can go into the IRA. Now, a lot of what I'm saying falls into both the 401k and the IRA, but I'm going to talk more about that as we go. The one exception with the 401k on this is typically, not always, but typically, if you're employed, the 401k you have with that current employer, you're not going to be able to roll into or roll out of that current plan. They don't want their employees doing that. Now, it is true that a certain amount, a fair amount actually, of adoption agreements with group 401k plans, once you're over 50, will actually allow you to do what's called an in-service rollover, meaning you're going to stay employed there, but you're going to roll over some of the funds. And there's some rules depending on how the adoption agreement is written. Typically, no matches can be rolled out, but contributions can in that scenario. But you just have to ask your HR department or the plan administrator if your plan allows for in-service rollovers. And you do need to be over 50 usually for that to take place. But I digress. Let me keep going through this. The other step is forming what's called an LLC. Now, this is not an LLC you might already have that holds real estate. This is a special purpose LLC. Okay. In fact, I'll talk more about disqualified parties down a few slides from now, but we cannot, nobody can use your existing LLC that you have for this purpose because it's in your name and you're a disqualified party. Okay. It would be like asking, can I sell a rental property to my IRA that I already own? You can't do that. That would be a prohibited transaction. It's the same thing with an LLC. This is not your run-of-the-mill LLC. Again, it's special purpose. Its single member is the IRA. You are the manager of the LLC, which is what gives you the checkbook control. From there, the bank account is funded, and the LLC is actually what holds all the assets, including the bank account. And so all those are in the LLC. So if you buy a rental property, it's in the name of the LLC. Title is taken in the name of the LLC, which again, its single member is the IRA, right? Its special purpose is designed to be owned by an IRA. And so all assets are held in the LLC. And when you invest, all the money must go into and out of the checking account that you will have, which is the home for the funds until you deploy them into investments. So all income and all expenses related to everything that the IRA owns and invests in must go into and out of the IRA LLC checking account. You can, but you don't want to you definitely don't want to commingle, and you also don't want to do an accidental distribution because that can cause taxes and penalties to occur. Commingling is even worse. That can cause the entire IRA to be disqualified, but that's kind of a whole nother conversation. Just keep the money in the IRA and the LLC and you're just fine. Now, that's the IRA. Again, I will talk more about checkbook control and the advantage of it as we continue on. But I want to get into the solo 401k. So again, I already mentioned it's primarily for the business owner and their spouse. And here's how it works in a diagram. You have a plan sponsor. Okay, the sponsor of the plan is the business, right? It could be a consulting business you have. You could drive for Uber and it could be the sponsoring business. You're probably sole proprietor in that situation, could sponsor a solo 401k. Real estate agents, every real estate agent qualifies for a solo 401k. Again, just the legitimate self-employment activity. You don't have to be making a bunch of money in your business. In fact, you don't have to make any money in your business. You just have to be in business to make money, right? I can get my real estate license tomorrow and qualify for a solo 401k. I haven't sold a single house yet. But the business sponsors the plan. Okay, that could be sole proprietor, corporation, LLC, partnership, any sort of structure, business structure can sponsor the plan. So the sponsor, the business, adopts the plan and the trust, the IRA, the solo 401k is a trust. Okay, and the solo 401k trust is actually what holds all the assets of the plan. Now so in the IRA, you're the manager of the LLC that gives you checkbook control. In the 401k, you're the trustee of the trust that gives you checkbook control. And so all assets, all accounts, including the checking account, are in the name of the trust. And you can actually open an account at any bank or financial institution or brokerage. That's why at the beginning in the diagram, I was saying the off-road vehicle can go where the bus goes, right? Your conventional assets, and also off-road. Because in the solo 401k, the question that comes up is, okay, I'm going to establish this thing. I'm going to transfer in, let's call it $100,000 from a qualified plan, and I'm going to look for the right investment. But I don't know when that's going to come up. I've got one, but it's only going to be 50,000 and I've got 100. I really don't want 50,000 in the checking account, not making much interest. By the way, it's not true that it's a non-interest bearing account, but it is like 0.6% or 0.06. I can't remember. It's very nominal. So it's not earning much interest. But what you can do in the solo 401k is you can open a brokerage account at any brokerage, actually. It's called I'm drawing a blank on the name. Non-prototype account is what it's called. It basically means it's a non-custodial brokerage account at Vanguard, Fidelity, Schwab, T. Rowe Price, Edward Jones, any of them. And then you can invest using, again, it's the same plan. It's the solo 401k plan. And you invest in what they offer: stocks, bonds, mutual funds, ETFs. Meanwhile, you're also using that same 401k plan to invest in some real estate syndication offering, or buying an investment property, a rental with it, or whatever the case may be. Do your due diligence on this. We're not here to give financial advice or investment advice. I'm just telling you what you can do with this. Just like the IRA, all the income and expenses must go into and out of the checking account and the trust. The account that's holding the money, which is in the name of the solo 401k trust. So let's talk about the contributions. It is over $75,000 per year per participant. Now, you have two different hats you wear being self-employed. You have the employer hat and you have the employee hat. The employer hat is where the contributions come in are called employee contributions, also known as elective deferral. So if you have a W-2 job, this is subject to the same limits. Okay. For 2024, it's $23,000 per year for each participant if you're under 50. Once you're 50 and older, you actually have another $7,500 catch up that you can do. So $30,500. Now, the beauty of the employee contribution or elective deferral is that it can be 100% of what you pay yourself or what you make. Okay. Now, if you're let me talk about the employer first. Okay, so that's 23 or 30. So you're probably asking yourself, well, how do I get to 76.5, right? Again, over 50, 69,000 total if you're under 50. How do I get from 23 or 30,500 up to that maximum amount? Well, here's how. You wear the other hat. You actually wear the employer hat as well. So the IRS allows you to do what's called a profit sharing. Now, this is a percentage. It's a business expense for the business, and it's always made as a pre-tax contribution. You can easily convert it to Roth and make it a Roth contribution as well. So either one of these can be Roth 401k contributions or a combination of the two. It's up to you. Again, pay taxes on the seed or the harvest is the question you're asking, and get with your CPA to determine what makes the most sense for you in that particular tax year. But the employer contribution is roughly 20% of the profit of the company, or 25% of the total payroll. So if you're S Corp and you're running payroll, simple math, you pay yourself a W-2 of $100,000, you're going to be able to put in the 23 as the employee contribution, plus another 25,000 on top of that as the 25% of the 100,000 for the total contributions. Okay, that's the easy way to say it. If you're not an S Corp and you're not running payroll, it's let's say $100,000 net profit of the company is what it's based on. 20% of that plus the 23,000, right? Or the 30,500 if you're over 50. So I just threw a lot of numbers out there. Hopefully that makes sense, but that's how the contributions work. Proverbs 21:20 says, the wise man saves for the future, but the foolish man spends whatever he gets. Indeed. All right. Now we're actually going to talk about something super cool. And this is there's actually a Secure Act 2.0 that came out not too awful long ago that allows for an up to $1,500 tax credit that you can qualify for. You can actually claim it from the IRS to establish a solo 401k. So the way it works is it's also known as auto enrollment, auto contribution. Auto contribution makes it sound like you have to automatically contribute to the 401k. And while that is a stipulation in the requirement, it's kind of funny, but they actually let you opt out of that. So you don't have to automatically contribute a certain percentage of each paycheck or your gross profit if you're a sole proprietor, net profit if you're a sole proprietor or whatever. So you can opt out of that, or you can do it automatically. It's up to you. but it's spread out over 3 years, so $500 each year. And the beauty of this is at the cost of what we charge, this is almost 5 years of having your solo 401k is what this will cover. And so essentially, if you look at it, in that first 3 years, you won't have spent $1,500, but you'll have gotten that tax credit from the IRS. So it's quite literally like saying the IRS will pay you to establish a solo 401k. So let's talk more about the checkbook control. The checkbook control is probably one of the best things that has come along in regards to self-directing. Here's why. There's custodial 401ks, self-directed 401ks. There's custodial self-directed IRAs. Let me back up a little bit. Every IRA has to have a custodian per IRS guidelines. You can't eliminate the custodian in an IRA. Now, with the 401k, we can eliminate the custodian, which is super cool. But the LLC route in the IRA, checkbook IRA, IRA LLC, these are different names for the self-directed IRA. When you have checkbook control, actually lets you bypass the custodian when you're making investments. The custodian's still there. They're still in the mix. You have to do the annual valuation with them. Any rollovers, transfers in will have to be done through the custodian. Roth conversions will have to be done through the custodian. So the custodian's not out of the picture completely, but for all intents and purposes, they are in the self-directed IRA when you're making investments. So let's say you want to invest in rental real estate. Well, the custodian IRAs will charge you, typically, they'll have transaction fees. Some of them have like a flat annual that covers as many transactions as you want, but they all vary depending on their fee schedules. Now, with the custodial, no matter what they charge for that type of account, which again, we don't offer, we only do checkbook control. No matter what, you still have to go through the custodian for all transactions, all investments, all payments, everything. Typically, they have an online portal that you have to submit everything on. Think about buying a property. Okay, the purchase agreement here in California is 10 pages, but it has like a ton of add-ons as far as disclosures and such. Obviously, that's different in every state, but the custodian, you have to upload that to the custodian, and they have to sign everything, and they have to fill out everything, and they have to be the one that hold the asset for benefit of. So the custodian for benefit of your IRA. Okay, so there's a lot of disadvantages to the custodial plan, not the least of which is the time involved in submitting a request to the custodian to invest in something, or make a payment to a plumber for a repair that had to be done at a rental property, whatever the case might be. With checkbook control, you have a regular checking account. So now I'm into the category of both the way the 401k works and the IRA. You have a regular checking account. You have a checkbook. You don't have to order checks. You can make payments or whatever with checks, but you can also do online bill pay. You can also do wire transfers. Checkbook control is great. It's like having a regular checking account for your retirement account. That's literally what it is. You have a debit card as well. So just be careful you don't mix it up with your personal debit card and accidentally buy your groceries with your IRA. That would be not a good idea. I would not keep it in my same wallet as my regular debit card, but I digress. So checkbook control is huge. With the solo 401k, we use the trust structure. You're the trustee. We literally eliminate the custodian. So it's great. You're in charge. You're the fiduciary. You do have to do general bookkeeping. You have to make sure that you, as the fiduciary of the retirement plan, you have to remember it's separate from you. It's a separate entity. You have your own social security number. The retirement plan has its own EIN number. You have the fiduciary responsibility of investing wisely and growing it, and also doing general bookkeeping and accounting with it as well, which we assist with. We just don't do it for you, but we will help you with that. Let's talk about leverage briefly. So you can actually get leverage or get a mortgage for rental real estate. Now, it has to be non-recourse. So what does this mean? It means you can't provide a personal guarantee. The property is the only security for the loan. So your credit, your income is not a factor. In fact, I don't even believe they run it. Now, they will check you out to make sure you are who you say you are, because you're responsible for this investment, even though it's owned by your retirement account. But you're not vouching for the loan. If a default occurs, they're taking the property back. They're not going after you or your credit. Now, because of this, the property's got to cash flow. If it doesn't cash flow, it's a terrible investment anyway, but it's a terrible investment for the lender as well. It does require 30 to 50% down because of, well, first off, it must cash flow. So it's going to take that much typically anyway, especially here in Southern California, but some markets, maybe you can get away with less, but 30 to 50% down. You do have to have reserves. Now, cash flow is, a couple $100 a month, 300 maybe. You do have to have reserves. And in the IRA, this will trigger leverage will, what's called a UDFI, which actually stands for unrelated debt finance income, which triggers the tax called UBIT, unrelated business income tax. This is only in the IRA. The solo 401k is exempt from UDFI and UBIT on leveraged real estate only. Now, the other way that this tax can come into play on both the self-directed IRA and the solo 401k is if you are running an active business in the retirement account. People come to us all the time and they say, hey, I want to open a store. I had this conversation with someone the other day, actually. I don't know what kind of store it was, but some kind of brick and mortar store they wanted to open, and they were trying to get away from, which I don't blame them. They're trying to avoid paying, all this income tax on the income and business tax. And so they wanted to do it in the IRA. Well, actually, I think he qualified. No, he didn't qualify for a solo 401k. He wasn't self-employed. He wanted to do it in a self-directed IRA. And he certainly could. The problem is the business income, because it's an active business, it's not passive, is going to be subject to this UBIT tax, which scales up to 37%. And so it could be pretty hefty. Now, don't let it scare you when it comes to leveraged real estate, because again, solo 401k exempt from leveraged real estate, not from running an active business, IRA not, but it doesn't scale up to 37% until you get to around 12,500 of income for the year. And you actually, on that portion, which the only income that's subject to the UBIT when it comes to leveraged real estate is the income that comes in because of the mortgage. So if it's 50% mortgaged or 50% leveraged, then 50% of the income is going to be subject to this tax, minus you actually can depreciate and deduct expenses. People say, sometimes I see on the forums all the time, people will say, well, I don't want to buy real estate in my IRA because I can't take advantage of the tax deductions and reduce my taxable income with depreciation and all that stuff. Well, that's true. You can't, but you can depreciate and you can take advantage of some of the expenses in the IRA. But again, it's only on the portion that's subject to this UBIT derived from the portion of the real estate that has a mortgage on it. I know that's kind of complicated, but just know that if you do an IRA and you're going to buy real estate or invest in a syndication offering that has leverage on it, you're going to need to file what's called a 990T tax return for the IRA, and you just do your due diligence on what that's going to look like. One more note on this, and I'll move on. Inside of a syndication offering as a limited partner, you're typically going to show a lot of losses or enough losses rather, for the first 1 to 3 years that you won't have any UBIT anyway. Even though money's coming in, you're getting deposits because you're getting a return, but it's being offset as far as the taxable income goes, being offset by the cost segregation they're typically going to do and the other expenses. We do have a list of non-recourse lenders on our website. If you want to check that out, there's probably, 10 or 12 on there that you can talk to, and we have some of the terms are actually written right there on the website, so you can check that out as well. The link is there. If you're just listening, SenseFinancial.com /non-recourse lenders. Okay, let's talk about disallowed investments. Collectibles, so those are like baseball cards and stamps, by the way, on the left there, but collectibles, cars, paintings, that sort of thing, you can't do in either the IRA or the 401k. Now, the other one that the IRA only is not allowed to do is life insurance. There are some ways to invest in life insurance with the solo 401k, but it's nuanced and not my specialty for sure. But just suffice it to say that the only disallowed investments are collectibles and life insurance. And then the other part of it is what's called disqualified persons. Okay, so you, your spouse, your parents, your grandparents, your children, and their spouses, direct descendants, are disqualified from working for, getting compensated by, benefiting from, providing services to the retirement account, all of that. Okay, so if I'm a real estate agent, I can't represent the IRA or 401k on a purchase. I can't do that. Not only would I'd be breaking two rules, actually. I'd be getting compensated for it from a commission perspective, but I'd also be providing services for the retirement account, which you can't do. Even if I gave up all my commission, as like a credit to the IRA for the purchase, I still can't do that. I have to, because I'd still be providing services. Okay, so the easy way to say it is you can do the white collar work, but you can't do the blue collar work. Okay, I can do my research behind the computer. I can sign a purchase agreement. I can review disclosures. I can hire the contractor that's going to swing the hammer. I just can't swing the hammer myself. Okay, so that's the easiest way to say it. Another example would be if I had a rental property in, let's say, some other state, and my son was going to go to school in that state. He could not stay at that rental property if the IRA or 401k is the owner of that property. That would be benefiting from something that the property or that the retirement account owns. Even if I charged him full boat on rent, I still can't do that. All right, so here's a quick snapshot of the self-directed IRA, custodial on the left there, which we talked about, we don't do, and then the IRA LLC, checkbook IRA in the middle, and then the solo 401k on the right. So one thing I forgot to mention is the personal loan, also known as a participant loan for the solo 401k. The IRA does not have this. With the solo 401k, you can actually borrow in the form of a participant loan from the 401k up to $50,000 or 50% of the total plan value, whichever is less. And you pay it back over a period of 5 years or 15 if you use it for buying a primary residence. And it's prime plus 1% is how that works. And you can use that for any reason. It's your money once you borrow it. You just have to pay it back to the retirement account. So we had a nurse who did some contract work, so she qualified for a 401k. We did the solo 401k for her. She originally was going to take a distribution from her IRA in order to pay off some high interest credit card debt, about $10,000. And her CPA said, you better take out close to 20 because between taxes and penalties, that's what it's going to cost you. She found the solo 401k. We established it for her. She did the participant loan. She didn't have to take out 20. She didn't have to take out 12. She didn't have to take out 15. She borrowed only the amount that she needed to pay off the high interest credit card debt. And then she paid her 401k back. So this has a lot of applicable reasons why you would use it. We don't necessarily want to establish a solo 401k for the primary reason of doing a participant loan. Again, your fiduciary responsibility is actually investing the money for your retirement. You're looking out for the benefit of the retirement account until you start to take distributions at retirement time. So your job is to grow it as quickly and swiftly and effectively as you can while following the rules. Again, no UBIT on leveraged real estate, only in the solo 401k. Another example of that is flipping houses. You can, if you're flipping houses over and over again inside the retirement account, the IRS is going to deem that you're running a business. That's going to be subject to UBIT. It still might make sense. I'm not saying don't do it, but you're probably going to get hit with the UBIT tax on that. Now, if the primary nature of the retirement account is buying and holding rental properties, and then maybe you're buying 3 to 4 a year and you flip 1 or 2 a year because the numbers just make more sense to do that, you're not going to get hit with the UBIT tax on that because it's not the primary nature of the retirement account. But if you flip those numbers and you buy maybe 1 or 2 rentals and you're flipping 3, 4, 5 a year, that they're going to say you're running a business in there. So just be aware of that. Consult your tax advisor. And then, of course, the max contribution limits are vastly different between the plans. And yeah, that is how that works. We do have a free ebook that's super cool. Dimitri wrote this not too long ago, and it's called The IRA Makeover. Don't misunderstand the title. It talks about solo 401k as well. But definitely recommend you checking that out. It's free. You can go to SenseFinancial.com /IRA makeover and download that PDF. And then lastly, I just want to offer a consultation. If you are wanting to talk privately about your situation, we do offer complimentary consultations. So just jump on my calendar. You can go to SenseFinancial.com /free consultation, and we'll have a conversation at a time that works for both of us. And so with that said, let's go to questions. Natalie, my trusty partner here, I see we do have some questions.
Yeah, we do have a few questions. Quickly want to add, if there are any other questions, please use this time to type them up. But first question here from Alexander. When did this start? Brett started presenting around 11:03, so you did not miss much there. Next question is from Alan. Can I invest my personal money to partner with my LLC owned by my self-directed IRA or solo 401k to form a new LLC to invest in rental properties?
Maybe. I'll explain. Alexander, everybody's going to get emailed a recording of this, so if you want to go back and watch it, or anybody else, you certainly can. Okay, Alan, can I invest my personal money to partner with my LLC owned by my self-directed IRA or 401k to form a new LLC to invest in rental properties? You could. So you could create what's called a multi-member LLC and potentially partner with your retirement account. I wouldn't necessarily recommend this. It causes some complication, particularly in the form of making sure you properly delineate the percentage owned. Okay, everything has to be pro rata, right? So if it's 50-50, let's just use that for simplicity's sake. 50% of the investment came from you, 50% came from your retirement account. All the expenses and all the income has to be divided accordingly. So that's one complication. The other complication is that it's going to be a little more costly. We don't do multi-member LLCs here at Sense Financial. You'd need to figure that out somewhere else. You could partner with your retirement account without doing the multi-member LLC and just both pitch in money. The challenge with that is you cannot enable your retirement account to be able to make the investment. So simple math, if the total investment is $100,000 and you are going to put in 50 and your retirement account's going to put in 50, the retirement account must be able to make the investment without you. So if the retirement account does not have enough money to do the 100, you cannot bring in the difference. You cannot enable it to be able to make the investment. It would need to be able to do it without you. So that's how that works. The multi-member LLC situation can get around that, but again, consult your tax advisor or tax attorney for sure.
Okay, another question from Alan. Do I need to pay self-employment tax for the allowed contribution amount for the solo 401k? For example, the first 30,000 and he's over 50 years old.
Well, you are going to, so the 30,000, you're over 50. So 30,000, let's just say it's the employee contribution. That is, again, it's either tax deferred or Roth. Now, if you're doing, like, if you're a sole proprietor and you're not on payroll, right? There's no payroll requirement. You're just going to make that out of the income from the business. You're going to pay, I believe you will pay self-employment tax on that, but that is definitely a great question that you probably need to discuss with your CPA. I actually don't know the answer to that, to be quite truthful. I think you probably would, but I'm not 100% sure on that. I do know that if you're running payroll and you want to max out, let's say you're 49 and you want to max out to the 23, you would need to run a gross payroll for the year of about 25, because you do have to account for FICA and Social Security and stuff. And I know that's not your question, but yeah, definitely consult your CPA on that.
Okay, question here from Alexander. Do you have to roll over all the IRA, or can you do part of it?
There's no limit to rollovers or transfers in from qualified accounts. You can do 10,000 today, 10,000 tomorrow, and 10,000 every day of the year. Obviously, you're not going to do that, but there's no limit. It's totally up to you.
Okay, next question is from Josh. What if you purchase land and then want to build on it? Are the funds is the only funds you're able to use have to be from the 401k? If so, what would happen if you built something on it and didn't use 401k funds?
Well, you wouldn't be able to use your personal funds for this. And all the disqualified parties, Josh, that I mentioned, you, your spouse, your parents, your grandparents, your children, and their spouses you couldn't use their money for this either because they're disqualified. So you would need to probably get a loan from a third party to be able to do that, or the funds need to come from the 401k.
And then another question from Alexander, is there an age limit on setting up one of these?
Well, you need to be 18 to do it without like a parental consent. We have a solo 401k, at least one for a minor, but the parents are basically in charge of it for the minor. So it is possible, but most people are adults for sure.
All right, well, looks like that was actually, we do have one more question from Veronica. Will the amount you get for the non-recourse loan be a difference between what you have in your LLC and the cost of the property you want to purchase?
I'm not sure I understand the question. Let me read it again to help me. Will the amount you get for the non-recourse loan be a difference between what you have in your LLC and the cost of the property you want to purchase? I don't understand that question. You need to put 30 to 50% down, and then the lender will provide the rest based on the situation. They all have different terms and different requirements, so you should go through the list of them on our website and just call them, or again, some of the terms and conditions are actually listed right there on the website. You can ask, but if Veronica, we'll hang out for another few seconds here, and we will see if you have any clarification to add, because I'm not sure I'm answering the question. To answer that last question, Kay, you can just go to SenseFinancial.com /free-consultation.
Okay, we'll wait.
All right.
Oh, we do have a follow-up from Veronica.
Okay.
If you have a 100K in your LLC and the property costs 250, non-recourse loan amount will be what?
Well, it would be the difference between what you have and 250. So in that scenario, 150,000. You're going to have money for closing costs, and you're also going to have some in the 401k or IRA for reserves. But yeah, the 150 is the answer to that question, to answer it as simply as possible.
Okay, so I think those are all the questions. So we will go ahead and close up here. Thank you again, everyone, for joining. If you would like to speak to Brett on a one-on-one, please reach out to our office. We'd be happy to set something up. But again, thank you for joining. Hope you all have a wonderful day.
Thank you, everybody. Really appreciate it. Take care.